Look at that number on your 401k statement. Go ahead, close your eyes and picture it. Maybe it says $500,000. Maybe it says $1 million. You look at that number, and you feel a sense of pride, don't you? You think, wow, I did it. I saved, I sacrificed, and now I have $1 million to spend in my retirement. Well, I am here today to give you a very serious, very loving reality check. I need you to wake up and look at the truth, because if you don't, you are going to walk straight into a financial nightmare. That balance on your screen? It is a lie. It is an absolute illusion. It does not tell you what you can actually spend, and if you start writing checks based on that total number, you are going to run out of money long before you run out of breath. Why am I saying this to you? Because we have been conditioned to believe that our retirement account balance equals our net worth, which equals our spending power. But it doesn't. When you look at a traditional 401k, you are looking at a gross number, not a net number. You are looking at a partnership account. And do you know who your partner is? The Internal Revenue Service. Uncle Sam is sitting right next to you, looking at that exact same $1 million balance, and he is smiling because he knows a massive chunk of that money belongs to him. This is the fear that keeps so many of you up at night. Will I have enough? Can I afford to travel? Can I afford to pay my medical bills? You are terrified of outliving your money, yet you are calculating your retirement lifestyle based on phantom dollars. Every single cent you put into that traditional 401k was pre-tax. It was a beautiful tax deduction when you were working, yes, but that was just a tax postponement. You didn't avoid the taxes, you just kicked the can down the road. And guess what? You have reached the end of the road. When you pull money out of a traditional 401k, it is not taxed at a special, lower capital gains rate. No! It is taxed as ordinary income. Every withdrawal is treated exactly like a paycheck from an employer. If you are in the 22% federal tax bracket and your state takes another 5%, that means 27% of your withdrawal goes out the window before it ever touches your pocket. So, if you withdraw $40,000 to live on, you don't get $40,000. You get less than $30,000. If you needed that full $40,000 to pay your property taxes, your insurance, and your groceries, you are suddenly short by $10,000. Multiply that mistake over 10, 20, or 30 years, and you tell me what happens to your nest egg. It vanishes. But it gets even more dangerous. You might think, well, Susie, I'll just control my withdrawals. I won't take out much, so I'll stay in a super low tax bracket. Oh, really? Enter the required minimum distributions, or RMDs. The government is patient, but they are not that patient. When you hit age 73 or 75, depending on your birth year, the IRS forces you to start taking money out of that traditional 401k, whether you want to or not, whether the stock market is up or down. They calculate how much you must take based on your life expectancy, and if you refuse? The penalty used to be an astronomical 50%. Today, it's still a brutal 25% of the amount you were supposed to withdraw. These forced distributions can create a massive tax avalanche. Suddenly, an RMD pushes your total income into a higher tax bracket. And it doesn't stop there. That increased income can trigger the taxation of your Social Security benefits. Up to 85% of your Social Security checks could become taxable just because your 401k RMD forced your income up. Then, you hit the Medicare premium surcharge, known as IRMA. Suddenly, your monthly Medicare Part B and Part D premiums double or triple because your 401k balance forced you to take out too much money. Do you see the trap? Your 401k balance is holding a ticking tax time bomb, and you are acting like it's cash in a checking account. Then we have to talk about market volatility and the sequence of returns risk. This is the question you must ask yourself: what happens if the market drops 20% the year I retire? If you have $1 million and the market drops, you now have $800,000. If you are still withdrawing a fixed dollar amount to live on while the market is down, you are selling your mutual funds and stocks at absolute rock bottom prices. You are cannibalizing your principal. When the market eventually recovers, your account can't recover because you already sold off the shares to pay for your lifestyle. A down market in the early years of retirement completely rewrites what that 401k balance can actually generate for you. So, what is the actionable takeaway here? How do you protect yourself? How do you find out what you can actually spend? First, you must create a net 401k balance mindset. I want you to log into your account today, look at that total number, and immediately slash it by 25% in your mind. If it says 800,000, mentally look at it as 600,000. That is your real baseline. That is the money that actually belongs to you. Second, you need to look at your retirement income as a puzzle with different pieces. You cannot rely solely on a traditional 401k. You need tax diversification. If you are still working or recently retired, look into Roth conversions. Converting a portion of your traditional 401k into a Roth IRA allows you to pay the taxes now, at today's known tax rates, so that the money can grow and be withdrawn completely tax-free later. No RMDs, no future tax hikes affecting your Medicare premiums, and no surprise bills. Third, you must calculate your true safe withdrawal rate based on your net assets, not your gross balance. Use a conservative guideline like the 4% rule, but apply it to your after-tax reality. If your true net balance is $600,000, 4% of that is $24,000 a year, or $2,000 a month. That is your safe spending limit from that account. If your actual expenses are higher, you need to adjust your lifestyle now, before the money runs dry. True financial freedom isn't about what you accumulate, it's about what you get to keep and spend cleanly, without fear. Face the numbers, account for the taxes, protect your principal from market drops, and take control of your financial destiny today.